In the United States, credit as a percentage of GDP is 216%. In East Asia, credit as a percentage of GDP is 170%. South Africa, it's like 90%. But then you dig into the markets where we play, which is like Uganda, Nigeria, Zambia. These places, we did deals in Djibouti and Guinea this year. Typically, less than 20% of GDP is credit to the private sector. I think one of the questions is, okay, well, you can put money in, but that's great. Everyone can put money in, but how do you get it out? And I think our real statistic that's cool is now we've hit 31 exits as a firm. And weighted average IRR, pretty good on those exits, right? And I think the main reason why is not because our return has been crazy high. It's just we've avoided on how do we find situations where you don't lose money. Character is the most important feature of credit. You can't outstructure character. If you're dealing with people that want to cheat you, they're going to be smarter than you.
Hi, Isaac. Thanks for coming on. Really appreciate it.
Absolutely, my friend. How are you doing today?
I'm great. I want to start off by, you started your career in finance at Goldman Sachs in New York, and then you moved to Africa, right? Like, what did you kind of have to almost unlearn from traditional finance to be a good investor in Africa?
It's a good question. I think fundamentally, there are many premises in investing that folks take for granted. Like a lot of the times folks think investing is buying at a price where the cash flows of the company are better given the price that you've bought. And if the cash flows are there, then the liquidity will follow because people will recognize, oh, this company's making cash, so then I'll invest. And there's always a buyer at some other price. And that's sort of one school of thought. Another school of thought is, okay, I'm going to buy something because it's going up, and then, it'll keep going up because someone else will buy it from me at a higher price later. In Africa, both schools of thought break down. Because if you think about the liquidity in these markets, it is just a fundamentally different picture. So let's look at it very, very straightforward. So in the United States, credit as a percentage of GDP is 216%. In East Asia, credit as a percentage of GDP is 170%. Okay, South Africa, it's like 90%. Okay, but then you dig into the markets where we play, which is like Uganda, Nigeria, Zambia. These places did deals in Djibouti and Guinea this year. Typically, less than 20% of GDP is credit to the private sector, right? So it even makes, quote unquote, like emerging markets like China, Vietnam, India, these are vastly more liquid markets because credit as a percentage of GDP is a great liquidity measure because it tells you how much of the economy are the banks willing to lend against. Right? So if a creditor will extend leverage against something in the economy, it's because they believe it's monetizable. So the fact that US is 2 times GDP means that, okay, oh my God, everything is sellable and everything is sellable fast. In Africa, if you have 20% GDP, it just tells you that there's not a market for stuff, even if it's a high quality asset. And so you have to basically forget a lot of the assumptions that go into investing and think really from a first principles perspective. Like if I put capital in, how do I get capital back? And that I think is where TLG spends 90% of our time thinking. Frankly, we look much less at the quality of the business, much less at the quality of the entrepreneur. Of course, we look at those things, it's very important. But the main question we think about is how is this entrepreneur, how is this business going to actually get capital back out of the business?
So you think you spend a majority of your time basically de-risking the investment, right? Because
100%.
The majority of your activity is private credit. Could you maybe, before we dive into what the investment has to be or what the founder has to be like and what criteria you use to evaluate them, could you quickly explain for the audience what is private credit and why is it so important in the African context?
So Luis, it's interesting because we don't do private credit because we're credit people and that's what we do and that's what we know. We approached it very differently, right? We wanted to invest in Africa and we wanted to invest in the African markets that people don't know how to deploy capital into. So we don't do deals in Egypt. We don't do deals in Morocco. We don't do deals in South Africa, right? We're playing in the markets that often are called UN least developed countries. We have a live deal at the moment in Cameroon, right? Which, you grew up there some time, you know the country quite well, and you know that there are very few investors who are quite excited about deploying capital in that market, despite the fact that there are a lot of opportunities, right?
Absolutely.
So high level, to answer your question very directly, equity and debt are sort of what society has imagined are the 2 constructs of how you invest. Equity means that you're owning a share of the business. Debt means you're giving a loan to the business with the expectation that that loan is repaid back. Between the two, there are all kinds of transitory things in the middle. So let's go back to the very beginning, like 1600s. Okay, the Dutch East India Company is the first example of an equity transaction that is sort of well documented. The way that this worked is when the Dutch East India Company would make a voyage to go get spices or something from some part of the world, the equity investors would buy in to earn a share of what the voyage would bring back. This was before a time of liquidity. This was before a time that you could take your share in a company, sell it to somebody else. Before dividends, equity was quite straightforward. It's like, okay, I'm going to invest in this project, and the percentage I invest is the percentage of the return that this venture makes. Debt was, okay, we're going to lend, and in the event that your voyage doesn't make enough money, we're going to take the ship and we're going to sell it, right? This was the beginning of these capital markets. So that context is useful because when you go into African markets, the reason we do private credit is because when you think about these markets, if we buy into equity of, for example, an aluminum recycler in West Africa or an edible oils maker in Tanzania, your ability in a fund construct to exit those investments, in other words, to find somebody else who will buy your share in the business at the end of a 5, 6, 7, whatever the life of your fund is nigh impossible. So we've done private equity deals, but they're very opportunistic, right? Because you have to find a situation where the nature of the equity in the transaction has a mechanism by which you can exit
to achieve liquidity. Just to
precisely.
to dig into there. I mean, private credit is still like massively underfunded in Africa, right? Like there are not a lot of private credit funds. If it, like what you're saying is it's easier basically to return your capital and to generate a return and to have liquidity vis-a-vis basically recouping the loan in private credit. Why, if that's the case, and there's such a liquidity problem that everybody's talking about in private equity, but also VC, why is so much more money still flowing into private equity?
It's a great question. So the first thing is that actually the debt markets are much bigger than private equity markets because the main actors in the debt markets are the banks and the DFIs who lend to the banks in order to on-lend into these geographies. So if we just take a stack of FDI, most of capital markets is actually going into a form of private credit, right? But oftentimes when people think about private credit as a market asset, they're thinking, okay, a fund who is a strategy doing private credit. And the reason why was because, bluntly speaking, if you're doing private credit, your returns are not as high. Why? Because you have all kinds of downside protection. So the borrowers are going to be like, guys, like, why would we pay you crazy high returns in the event that you're also asking for my house, my dog, my guarantee, my everything as collateral, right? I can go to the bank. So as a result, the returns on private credit are lower and they are capped. On private equity, you have unlimited return, right? It just depends on what the venture does. But where the problem has been, and this is sort of well documented, the private equity returns in Africa, and I'm not talking about Morocco, Egypt, South Africa, where actually people have gotten decent returns, but in sub-Saharan Africa, sort of the heart of African countries, private equity has not returned capital. The IRRs that are generally marked are not realized. The benchmarks reported by Cambridge were negative, and as a consequence, Cambridge discontinued those benchmarks. So generally speaking, people have not been able to realize at a fund level. There have been case studies of exits, I'm not saying that, right? But at a fund level, there have not been realized returns for 20 years now, 15 years now, not since the early 2000s. So for a long time, people were putting money into private equity because global investors said, listen, I'm not going to do Africa unless you're promising me, 20, 25% plus returns. You can't get returns like that if you're also protecting your downside. No one's going to borrow at rates that would justify those returns. But in the pursuit of those high returns, the result has actually been a failure of the market to return capital and achieve the returns that anyone purported to do. So that's a long story short, but I mean, really there are three barriers. One is liquidity. There's no exits in these markets. Two is your high cost of debt, because what happens in these markets is that the currencies that are earned locally, all the governments have a constant short on their currency position. So think about it this way. If I'm Angola or I'm Nigeria, and I'm importing my consumer staples, right? Like take a look at Ghana. Ghana, when it was running 52% inflation a couple of years back, the main three contributors on the government website were maize, wheat, and dairy. There's no reason why Ghana cannot make more maize, wheat, and dairy, but these are imported into the country. Wheat is predominantly imported. Rice is predominantly imported and bought in dollars. So if you're buying your core consumer staples, the thing that people are eating every day in dollars as imports into the country, rather than making it, you have a constant short position on the domestic currency.
Because you have to trade your currency for dollars to then import goods.
Exactly right. Exactly right. Now, when you run that short position, that makes your currency go down and in turn makes those imported goods more expensive, which causes inflation to go up. When inflation goes up, the banks say, oh my God, we need to raise our interest rates to overcome inflation. So the domestic borrowing rates go up. And that's why for a long time you saw in Ghana 40% plus borrowing. Now it's come down a little bit, but still very high. Nigeria was running 40% borrowing rates. Now it's still come down high mid 20s. Sometimes actually most of the part mid 30s is what we're seeing today. Then like imagine trying to build a business on a 30% interest rate loan. My God, good luck, right? Like we complain here in London. It's like, I'm borrowing at 6%. This is so expensive. No one can build a business. It's crazy. So then what happens? You kill the domestic companies who borrow at the high rates and in turn deepens the reliance of the country on imports. And it's a cycle.
Because like the companies that could manufacture the goods that you import cannot, because they cannot finance the equipment, they cannot like finance the factory because it's too expensive basically to get loans to actually do that. They could, but they can't in reality.
Exactly, Luis. Exactly. So now we bring this back to the equity discussion. If I'm an equity investor, I face a depreciating local currency that's systemic because my country is a constant short on my currency. I face endemically high local cost of borrowing, which kills my return on equity. And I face a total dearth of liquidity on the exit market. And we want to package that in a 7 to 10 year fund. Now, people have talked about, okay, the solution is permanent capital vehicles. And by the way, I think that's true. We have a holding company that does opportunistic equity stuff on a permanent capital basis, right? But you can't build a fund like that because no investor wants to lock up into perpetuity. Fundamentally, investors I want to exit in 5, 7, max 10 years for VC, right? So what has to be done, and I think too often people who design strategies focused on Africa have tried to copy and paste what's working in Asia, what's working in LATAM, what works in markets that have much higher levels of liquidity and credit rails that already work, and then try to build private equity on top of that. And the problem in Africa, and this is the big thing, is that private equity only works when you have a functioning credit system. Credit is the baseline of the economy. I'm yapping for a long time now, but just take, for example, you'll find this very interesting. Blackstone, the first deal Blackstone ever did, okay, was with a company called Edgecombe Steel. Actually, sorry, this is the second deal that they did. That deal, they put $13 million down in equity to buy a $331 million position.
They levered their equity through debt.
Exactly. Because in the beginning, the private equity funds in the US were not big, but they had a leverage system fueled on the back of Milken's high yield bond market, where all of a sudden you could get leverage on these assets to punch way above your weight. In Africa, that kind of liquidity doesn't exist. So what ends up happening is, Blackstone buys a position, 13 million equity, 330 million valuation, right? They flip it to somebody who puts in 21 million of equity at an even higher valuation. So the credit is what facilitates the equity players to both come in and to exit. Now we come to why private credit, and frankly, any form of credit in Africa is so important, because without those rails in place, it is like trying to run a train through a dirt and mud land. You don't have the rails that are required for private equity or a normal liquidity system to operate if you don't have private credit, or not necessarily private credit, but any form of credit in place. We'll talk more about, I think, why the banks struggle to service their ecosystems with the volume of credit that's needed.
Yeah, that's actually like the next thing I wanted to talk about, because from my perspective, I thought that mature big companies that also like larger private equity funds in Africa would have access to credit, right? But it's mostly like this middle gap, the SMEs that lack that access of credit because they're maybe not as credit worthy, or they operate in maybe more risky or perceived risky jurisdictions.
Well, exactly. If you look at where most funds that do private equity invest today, the deal volume is happening primarily in Morocco, South Africa, Egypt. And the reason why is because that is where larger companies exist, and that is where access to credit is plentiful. You'll see some deals in like Francophone, but it's not a major area. Like, you're not seeing a weekly announcement of deals happening in those markets because there just aren't companies that are big enough, to exactly your point. These are jurisdictions where when you do a $5-10 million deal, that's something that the president is aware of, right? In some of these countries. So as a consequence, you're exactly right. And I think the fundamental challenge that banks face is that banks are capitalized from a deposit perspective, but do not have very much access to long tenor money. So as a result, they're very cautious about lending on the long tenor.
And just for the audience, maybe somebody doesn't know the term, like tenor, basically just like a longer duration, right? Because like the deposits that the customers make at the bank should be able to withdraw at any time, so they can make really long-term loans because then they would be illiquid.
Precisely right, Luis. So, you'll have a situation where a bank will give a loan, but they'll do like an 18-month loan to buy an industrial asset that has a payback period of a couple of years. That's tough. That's really tough to make work, right? So I think that oftentimes the banks get too much flack. I think everyone's like, oh my God, the banks are not servicing the SMEs. It's like, well, guys, look, think about it for a second. The bank's main job is to protect depositors' money. The main job of the bank is to make sure that they don't lose the people who are holding their savings in the bank. And by the way, African banks have done a phenomenal job at that. I mean, you look at the last 30 years, there's a GEMS database published in 2024 by all these big DFIs. And on 1,600 African loans, the default rate of the banking sector is 4.7% at the 90% confidence interval. So you compare that to East Asia, 4.3%, India, 4.4%. Oh my God, the banking sector behaves like an emerging market that has way more liquidity. So that's actually phenomenal. Like that is an amazing achievement by the African banking sector. I think the reason why they don't lend to SMEs is because SME lending is very, very difficult. To your point, there's not that much equity balance sheet to invest. They are competing with lending to the government, who is often paying 20% plus local currency interest rates, and they often don't have collateral. It's a hard nut to crack. And I think that's kind of where TLG is quite focused is, okay, how do we help solve problems and work constructively with the banks to identify opportunities where credit can actually be put to work? So that's really the heart of kind of how we think about that question.
Yeah, it makes perfect sense. And that also ties into, I think, like the next point I wanted to touch on is, I mean, you just raised or like you're trying to raise 200 million, right, for a new fund, and you closed 75-ish
Yeah.
last year. Right?
Now we're at 102 million of commits.
Amazing.
And we're going to hit. Thank you so much. Thanks so much. Yeah, we'll be at 130 million in March, and then I think the 200 number is also including co-investments and all that jazz. So that's I think I will probably shake out. We have to see. I mean, there's a good amount of interest, but I think the number we're officially marketing is that by March we'll be at 130, and so that's we launched the fund in April. But I think what's cool is we've already deployed a huge amount of that fund. I mean, TLG as a firm did 16 transactions last year, which is that's pretty good in Africa. And critically, our model is quite interesting of how we look at those deals. And I think that's because I think one of the questions is, okay, we can put money in, but that's great. Everyone can put money in, but how do you get it out? And I think our real statistic that's cool is now we've hit 31 exits as a firm, and weighted average IRR is pretty good on those exits, right? And I think the main reason why is not because our return has been crazy high. It's just we've avoided on how do we find situations where you don't lose money. And I think that's where sometimes people get Africa wrong, is that everyone's out here trying to think, okay, average age of 19, huge population, let's take risk, let's grow, let's get big. But actually, like, if you just avoid the landmines, approach it with humility, recognize that's very hard and everything takes longer than you think it will, there's actually a set of opportunities that to us look safer and more de-risked than any other jurisdiction on earth. I mean, the deals we do, the return relative to the risk is amazing. And we're not targeting crazy. I mean, we're going to promise our investors, depending on the fund. I think our last fund has done in the last 3 years, 11% net of fees in dollar. In the longer term time frame, we're targeting like an 8 to 10% return in that fund, and that's cash pay. So, the new fund will target a little bit higher than that because it's doing longer term deals, but it's not crazy. But the key thing is we're doing that without leverage, and the downside protection that we have on these deals is everything we're focused on. So most of what we do now, Luis, is we will lend to these middle market companies, these SMEs that you're talking about, secured by guarantees from African banks. So, and we can talk through kind of more how that works.
Yeah, so like basically, like let's maybe like to make it also more concrete, let's take an example, like maybe a deal you love, if you can speak about deals you did.
Yeah.
So make it more tangible. Like how would it work from like, hey, the origination to like to the investment process, how you think about the business, how you de-risk, and then also you invest, and potentially then also later recoup the investment.
Yeah, absolutely, absolutely. I mean, look, so the heart of how we'll do an investment, and when you look at kind of the types of sectors we do, it's across the board. I mean, in the portfolio today is an aluminum recycler um, in West Africa. It's a agro processor in East Africa. It's a telecom company in kind of the Horn of Africa. So it's a pretty wide range of sectors. We're sector agnostic as an investor, and the reason why is because our thesis is that actually the local banks know the market better than we do. They know the market better than anybody. We are deeply humbled as investors in Africa, and I think we don't pretend to know better than the local banks. And so we approach those banks and we say, hey, listen, who are the borrowers that you like so much that you'd guarantee them? You'd guarantee 100% of the risk that we took on the borrower, and then we lend directly to those businesses secured by the guarantee of the bank. And that model is really, really interesting because it leads to some exciting outcomes. Like in Kenya, both the deals we have are education. In Tanzania, the deal we have today and the upcoming deal we're closing are in the agri sector, agri and food. In Djibouti, it's a different sector. I think it's every place is sort of tailored to the needs of the local environment, and that's because we'll partner with banks who know that environment better than we do, and then pave the way for that financing. So, put really concretely, when we give an investment, for example, to the aluminum recycler, we'll do a lot of value creation alongside of it. So we'll give a loan that's typically 5 to 7 years. It's to support growth of the business. In that case, the acquisition of machinery and items that allow the company to increase their processing volume. So that business, since we came in, has recycled an entire additional Eiffel Tower worth of aluminum, more than they were recycling before. And that's an incredible outcome. That's the case study we want. But it's like you need the financing. We have a value creation partner, which is McKinsey and the Manufacturing Africa team, ESS, BDO, and Indorama. They all work with us on investments in that industrial sector.
Yeah.
And so that's sort of how we'll structure it. So even though it's debt, it'll have elements that are sort of private equity like, in the sense that we do value creation programs on those portfolio companies.
No, I think I get it. So like a company, or like you work with local banks, right, in the markets that you want to invest in, and you ask them, hey, what's the company that's best performing but could need additional capital in form of a loan to unlock new markets or grow, buy equipment, machinery, etc. And then you will give a loan to them, and you will write they will underwrite a guarantee for that particular loan amount. You loan it to them, and then they can buy new machinery, unlock new revenue. So like their cash flows basically increase, and their profit, right? Because they make more revenue, ideally profitable. And then like after 5, 6 years, pay you back plus like interest. And should they default, the bank steps in and repays your principal. Okay.
100%. And that's
it's a
one
good
model. That's one model, right? I think the other model is, we'll lend against, like, we're the biggest financier of Nollywood movies, which is Nigerian Hollywood, right? So everyone always asks us, oh my God, how are you doing that? That's crazy. It's very high risk businesses. And so I think what we can do is we get very creative with how we structure around these transactions. So we can basically build a partnership with the off-takers of the movies, such that we get paid directly by the off-takers on existing films that are being paid over time. So that helps to de-risk. In other transactions, we've lent against international assets. We've lent against kind of innovative blended finance structures where philanthropy will provide a guarantee, with TLG taking the risk on the upside, with TLG taking some of the risk on the currency, for example. So I think we can be quite creative. I think, our approach is we tend to think, again, we talked earlier, we think not just about like, oh my God, is the management team quality, but we think very specifically of, okay, with this management team, can we construct a situation where our principal is not at risk, right? I think the management team, look, character is the most important feature of credit, point blank. I mean, the people you're working with will tell you everything, because you can't outstructure character. If you're dealing with people that want to cheat you, they're going to be smarter than you. So, we're humble about that. But I think if you select people on the basis that, not that, okay, I think that their upside plans are going to go amazingly, but on the basis that, okay, I think we can craft a solution where our downside's protected. That, I think, is a better model, but it requires you to change your attitude. I think a lot of investors, when they think about Africa, they're like, oh, I want, especially on the VC side, funds are targeting whatever X returns. And like, it's great, But at scale, people haven't realized those kind of exits. I'm hopeful that they can. That would be really great for the entire ecosystem. And there have been cases of exits that have taken place. But I think for us, we just recognize that beyond the kind of tech unicorn sectors, which are really, really sexy, there's just tons of industrial companies, of kind of core infrastructure companies, of environmental services, of schools, of telecommunication wire layers, like all this kind of stuff that needs to be built out. And that's really kind of where we're much more focused on, is how can we be a partner to banks to making sure that those enterprises can take off, and how can we think creatively about how to structure that stuff.
Yeah, absolutely. And I think it's also not a question of this or that, right? Because like, for example, for like a Nollywood movie or like a aluminium recycling plant, like no VC is gonna back that, right? Because it doesn't
Yeah.
fit into their worldview, into their fund model. So I think it's hugely important that funds like you exist, because there is this big middle that's just completely overlooked. And as you say, banks don't fund them, VCs don't fund them. Private equity is also struggling. So there has to be more of a backstop that supports banks in a way to create that massive middle, which most economies, to be honest, are built on, right? Most economies are not built on unicorns and tech startups. They're built
Yeah.
on like normal, boring businesses that employ people and that produce goods that are used by the population.
You're exactly right. And I think, where this gets really interesting is then to extrapolate it. I mean, set TLG aside for a second. I think that TLG has found one particular niche of models that work in Africa. But I think it's incumbent on the entire investment community to just think more creatively and push ourselves to think more granularly. So what do I mean by that? I've encountered a VC fund who has a very unusual model. When they invest money in the equity side, they require approval of line by line expenses of how that money is used. And they require a sort of partnership with the company such that they set their banking assets with the VC fund. That's an extremely innovative model. I mean, basically, you have a VC model that is thinking very actively about downside protection. I love that model. And I think to date, unfortunately, we've sort of constrained ourselves to thinking, okay, the creativity is going to be getting a philanthropy to backstop the climate risk on the deal. And, that's great until the philanthropy decides that they aren't interested in impact in Africa anymore because they're interested in other XYZ areas. And I think one of the things that the whole community has to really think about is like, guys, like, how can we push ourselves to be more innovative? Because I'll tell you, deals are not getting done, not because everyone's afraid of the risk. Deals are not being done because people don't think enough about how they can de-risk. So often we make DFIs into punching bags. And I'm like, guys, like DFIs are the only ones putting predictable anchor to any fund in Africa. All the time you hear funds that are 90% DFI funded. And I think we have to push ourselves to find new investors. To find new investors, you have to come up with a model that de-risks, that shows people, listen, here's my method of how I'm going to tweak to adjust to the realities of this market that has these challenges with liquidity, and hope that the next 10 years will be different than the last 10 years is not a strategy. I think that strategies can be built. I see funds doing it, but it requires us to move beyond, I did private equity in LATAM and it's going to work in Africa, because
Yeah,
the
you can't
environments
just
are, yeah.
yeah, you can't just replicate it. Talking about like LPs and investors, obviously there are DFIs and they're really important and they anchor a lot of funds. But if you're an international investor and a potential LP that wants to get involved in Africa, that wants to allocate, how would you approach it? Like what asset classes, what managers, like how would you think that through?
It's a really good question. It's a really good question. I think if you're an allocator in the world today, I think your job is very challenging in some ways. I think that when you look at the markets that have kind of driven the broad returns in the past 10 years, which is namely like US private equity, US VC, US equity, to some extent, Indian equity, to some extent, particular companies, not indices in other emerging markets. And then I think to some extent, private credit has been an interesting opportunity. Some fixed income has been an interesting opportunity. When you're building that whole portfolio, though, you face this really interesting challenge where equity valuations look really, really high. A lot of credit strategies have been dealing with companies and earning return from companies that are quite levered. And so basically, put simply, I think the developed world is at the top of a debt cycle. I think that creates the need to really think quite creatively with how you allocate funds. I mean, at a basic example, we know after '08, distressed credit and strategies that can take advantage of dislocations in credit were performed fantastically. I think to the extent that, you can take a view on, I think, the broad-based indices, which I think has been smart because no one can predict when a bull run will end. I mean, people have been talking about the end of S&P 500 returns for like 10 years now, and it's like every year just gets better.
Keeps going up.
Yeah, and so I think I'm not going to kind of bang the drum and be like, global allocators need to put tons of money into Africa. I don't think that's true. I think that global allocators need to identify alternative risk premia that diversify authentically away from the fact that a lot of their investments are correlated to just the leverage cycle in the developed markets that I think will hit private credit, private equity, and debt alike. You've seen the interest in gold and silver as one diversifier on that bent. And I think that is part of the reason why the rush has been what it has. Crypto is interesting because it's effectively just a proxy on US equity risk, but just it's like a levered play on US equity risk in terms of how it trades. When people are excited, then it goes up. When people are scared, it goes down. So I don't think that really offers that authentic diversification either. As much as folks were excited about it doing that, I think before it offers diversification, it has to prove it has a real economy use case. To date, we still haven't seen any killer application that leverages crypto to do something that enhances the average person's life. We have yet to see that application.
I would argue it is like the killer application and the only application that really works is stable coins, right? Like as a like remittance rail, as like even in
For
inflationary
sure.
countries to save.
But that's
Like the
because
application.
But that's because capital controls in those countries prohibit you from just owning dollars outright. It's like all crypto does is it facilitates you to skirt your regulation, which is valuable, especially in countries that have messed up regulation. But it's like I have difficulty unless it's like, hey, crypto's solution is for failed states. It's for countries where people can't trust the government to do their own banking. And maybe that is a use case, increasingly, unfortunately, a more prevalent use case. Actually, it's a fair point. It's a really good point, Luis.
Yeah, but apart from that, I completely agree. Like the whole decentralized finance crypto thesis, it just didn't come to fruition. I think like a lot of like financial applications and like trading of stocks, I think will be on blockchain distributed ledger technology. But
Yeah.
it won't like make any coins go up, like that won't
Yeah,
happen.
exactly. Exactly. And to your point, I think it just so far, I haven't seen the main coins people are buying offer an authentic diversification to their portfolios. So I think where Africa comes in play, and I think Africa is not the only jurisdiction. I think Central Asia is another jurisdiction that behaves like this. The Caribbean is another jurisdiction that behaves like this. These are just two jurisdictions I know very little about. Is that these are economies that are completely untethered to the developed market leverage cycle. And so to the extent that you can identify managers and strategies that are playing these markets in ways where, okay, like what they're doing is reasonable and is intelligent, is crafted to the local market, and they know that market well. Either they're based there or they work very closely with the local market. They need to have that expertise. I think it's really important. I think that those sorts of strategies are a thoughtful way to express views in Africa. And I hope that we can hit the point where one day you and I can be talking about, is there a bubble in African equities? I await that day because I think it's been a long time and people haven't, like, there was a narrative of Africa rising, I think 20 years ago, that now today has sort of not been broadly considered. But I'm optimistic eventually on Africa. I mean, there's no question that Africa will have a major destiny in the world because the demographics, the population, I mean, this is going to be the last place on earth where people are going to be young enough to work. I mean, the average age in Europe is now creeping up to 50. It's like, okay, like who's gonna build the businesses? Who's gonna work in the hospitals? Who's gonna work in the, and people talk about AI. I'm not so optimistic that AI is gonna replace humanity's desire for humans to take care of them. I think at a certain level, like hopefully it enhances it and it automates jobs that people don't want to do. But to me, we probably need 10 times the amount of people working in the education and healthcare sector that are working in it today. And if AI facilitates that kind of transition, like humans should be doing those jobs because education, as we know, is not about like memorizing things or learning equations. Education is about understanding the fundamental motivators of a human being. It's about mentorship. It's about seeing a person who you aspire to role model after. That's education, right? And that I think we'll struggle to have humans aspiring to role model after an AI, because there's just an inherent Also, I don't know how fast the technology will even be to get that kind of.
I get that there will be more need for that viral functions. It probably won't be replaced by AI because there is that desire for human connection, right? And also learning from humans. Yeah, I'm keeping this short because I know you have a call now. But
Yeah,
it was really a pleasure to have you on. Really learned a lot, and I think this was also super insightful for the audience. Maybe we do a part 2 to dive into even further topics.
absolutely. Absolutely. Luis, you're wonderful. And I appreciate also our conversation prior. I think on the next call, I hope that we have a chance to hear more from you because actually you have a lot of really interesting insights to share about this ecosystem. And so, thank you for your time. Perhaps I
Yes,
flip the questions on you for the next one.
let's do that.